What's up, HyperFast Nation? On this episode of the HyperFast Wealth Show, I sat down with an amazing guest. We talked about how he started investing in residential real estate in college, and then within 10 to 15 years, had built up a portfolio that he was able to then leverage to get into multifamily and now self-storage. He's running big syndications to help other people make passive income from real estate while expanding his own portfolio. And now he teaches other people how to do that through his coaching program and book, Next Level Income. Welcome to the show, Chris Larsen. All right, welcome to the show today, Chris. How are you doing?
I'm doing great, man. Happy to be here.
Yeah, I'm excited. I know we've got a lot of great stuff to talk about, including your book, which I know has already helped a lot of people and hopefully will help even more after this show. Before we dive into the show, why don't you tell people a little about your background and how you got to where you are today?
Yeah. So part of my background took me right through your neighborhood up there in Northern Virginia, like we were talking about before the show, Dan. We lived right around the corner from each other, which is such a small world. But before I moved to Northern Virginia, my wife and I, we met at Virginia Tech, which is where I bought my first property when I was 21. And the reason I went to Virginia Tech is twofold. I was going through engineering program down there, but really I just wanted to race my bike. And Blacksburg is a beautiful area to ride. And I thought it would be a good place for me to kind of launch my professional cycling career as I went through college. And going through that process, racing my bike between my freshman and sophomore years, I talk about this in my book. My best friend, my training partner, my roommate, Chris Strader, he passed away at a massive brain hemorrhage. I raced another year and I finished out that summer, and I was doing really well, better than I ever done. I was an All-American cyclist that year in college, and I was winning a lot of the local like pro-am races. But at the end of the season, I wasn't happy. I remember coming across a line and I was like, this is really not what I'm supposed to be doing anymore. I went back to school, I quit, and I didn't want to be an engineering student. I was going to be a professional cyclist. That wasn't something that was in the cards. I didn't really have like a core group of friends because all my friends were on the cycling team that I wasn't a part of anymore. I didn't have a girlfriend, any of that. So I went back to school, back to classes, and tried to rehab my GPA that had suffered the year before, as I was just kind of riding my bike and trying to kind of escape probably what was depression of losing my best friend. And I made this pledge to myself that I wouldn't let an opportunity pass me by, whether that was, a cool experience, like going on a trip, asking a girl out, which is probably how I ended up meeting my wife. And we're actually celebrating, as we record this, our 15th anniversary today. So I'm very grateful for that. But one of the other things that kind of went through my head, Dan, was that if you really wanted to take advantage of opportunities in life, you had to have financial independence. And racing your bike is not a way to achieve financial independence for 99.999% of people, unless you're like one of the top. So I was always thinking about like, how can I be entrepreneurial and make money? And that's what I devoted all my energy and attention to, that I had, devoted to cycling. So I started reading books and devouring information on the stock market. And if you think back, I was in college in the late 90s. Stock market was on a tear, just like it is today. I was day trading. I was making like $5,000 a month that year by trading in the stock market as a junior in college. Pretty good. But it was super volatile. And I was laying in bed one night at 3 a.m. And that's when it dawned on me, like, there's got to be a better way. Like, I don't want to be doing this in 20 years. And we're more than 20 years on. And I'm very grateful that as I educated myself, I came upon real estate, and I ended up buying a property down there, and another property, and another, and another, and another, as we moved around. And that's how I started in my real estate career. And long story short, I ended up transitioning that portfolio about a decade and a half later into commercial properties, which is what we focus on now, specifically in the multifamily and self-storage space.
Well, that's quite a background. I think one of the interesting things to highlight is the difference between cycling and real estate. And you got at it a little, but there's probably, I'm guessing on like two hands, you can count the number of cyclists that make $1 million a year worldwide.
Yeah, that's a really good estimate.
And guys who are cracking six figures, probably not many more, No. But yet the guys right below that aren't that far off in talent, speed, times, right?
Like 1%. It's so different. Yeah, so small.
But then you compare that to real estate, where it's like, there's some guys billionaires in real estate, right? But it doesn't. Yeah, you can be a lot worse in real estate and still making a lot of money, right?
Absolutely. No, it's, that is one of the things. And I think this is common in most sports. It's like, it's the 1% of the 1%. If you look at the Screen Actors Guild, it's the same thing. Like the statistic is so small of those people that are recognizable. I think the average in the Screen Actors Guild earnings is like $30,000 a year. I may be off by, 20 grand or something like that. But my point is, you think actor, they're making all this money. Professional athlete, your average professional cyclist in the United States probably makes like 30 or 40 grand a year, about what your average actor does. Not a really lucrative career. You have to do it for the love of the sport, which is what I was doing it for sure.
Well, how did you do your first real estate deal? How did that come about? What was it like? Were you nervous, scared, or just kind of ready to jump all in?
It's funny. Like, I still remember like the feeling of signing papers, and it's like the checks got bigger and bigger and like a zero would go on. So I love my first deal because it's like what some people pay for cars today. It was $90,000, and I'd used loan I used back then. I was able to put just a few percent down. I put less than $3,000 down on this $90,000 townhouse. And today we call it a house hack. So it was 3 bedrooms. I rented 2 of the bedrooms out, and I was basically living rent free. And the way I got that done, I had enough money in the bank to get that done. But my mom co-signed on the loan with me. I ended up buying her out a few years later. But it was super simple. It was just, a kid with his mom co-sign on the loan with him with a few $1,000s, and then renting a couple rooms out to a couple friends in college.
Hey, hold that thought for a minute. Do you have a client that needs to buy or sell a home in the DMV area? Then why not trust the highest selling team in the DMV, the Carrie Scholl team? We've helped thousands of buyers and sellers and would love to help your clients. And we guarantee we will save them time, money, and stress throughout the process, and they will be so grateful that you referred them to us. Go to carriescholl.com to learn more. Again, that's carriescholl.com to learn more about sending us your clients that need to buy or sell a home in the DMV area. That's carriescholl.com.
Gotcha. So, I was curious on how you got from the first deal you did to the, right before you switched everything to commercial.
Yeah. So it took me too long, in my opinion. This is what I tell people, and really the impetus why I wrote my book, which is, helping people shortcut the path that I took. So my book is really my story about where I started, my thought process of moving from single family. So I bought that first property. It's funny. I was just telling my 11-year-old son, this story this morning because he was asking me about it. I ended up buying the townhouse next door. I was talking to the owner, and he was moving. This was a year or two after I had moved in. And I bought that townhouse from him. So now I had 2 3-unit townhouses. So it was kind of like a little 6-unit apartment, if you will. And I got to rent out 5 of the 6 units, and I lived in one. And then I ended up buying another one in Richmond, which is where my now wife was living at the time, and then moved to Northern Virginia and bought more properties up there. And then, so I bought this portfolio of properties, and it was really simple. I thought, okay, I need to buy enough properties so after expenses, I could net $10,000. Now that's before debt service. So here's my thought process. If I could buy enough properties that net profit was $10,000, and then I could pay off the debt over 10, 15 years, then I'd have 5 figures a month coming in, 10,000 plus a month coming in. And I was like, that's enough to be financially independent. So the second step in the process was I need to go find a job so I can make more money, buy more properties, and then ultimately pay them off, which is what led me into the medical device industry, where I spent 18 years of my life doing that. So along the way, I spent, I bought my last property in 2005. So the numbers didn't start to make sense. Things were getting crazy. And I actually started to list the properties right at the end of, I think was it 08 the crash started, or 07?
It kind of depends on the area.
Yeah. It was 07.
I think in Clarendon, where condos, like those peaked a little early. They didn't fall quite as much though as the rest of the country.
Yeah. So I listed my first property 2007, early 2008. And I just remember the prices going down 10%, like the first month my property was on the market. And I was like, people would say I timed the market like horribly, but you could say I timed it perfectly if I could have sold everything on time. I literally top ticked the market. Like I listed my property, and as soon as I listed it, prices started going down. So totally missed the market. I was fortunate that we were still cash flowing positive. But I held those properties. So bought my first property in 99. So now we're 10 years out. So I held those properties for about another 5 years. And that's where, we're coming on, 2011, 12, and my mother had passed away at this point. And I started going through this process of reevaluation. And now I had all this equity built up in these properties. So, like that, say $10,000 down on a smaller property had grown to like $100,000. And, you think if you have $10,000, you got $3,000 a year coming in, it's pretty good. That's a 30% return. Well, if now you have $6,000 a month coming in, or a year coming in, but you have $100,000 of equity, that's only 6%. And then, if you're making good money, you're paying tax on that. So it wasn't a good deal. I was managing them myself. So as I looked around, I was at a meeting with my wife, and I was talking to a gentleman and just kind of lamenting, dealing with my own properties. He goes, "Oh, you should talk to my friend. They syndicate apartments." And I'm like, "Yeah, it's kind of the same thing, He's like, no, they run everything. So you can be passive." Because I was working 80 hours, sometimes more a week, being on call in the med device space. So I called his friend, and we start talking about the fundamentals, the demographics behind multifamily. I'm like, this is very familiar. Demographics and the baby boomer trends are the reason I went into the medical device industry. So I said, man, this sounds exactly like the thought process I went to. So I did some research, spent about 12 months, spent about a year going through the process, looking at different syndicators and operators, made our first investment. I think it was like at the end of 2013, may have been officially 2014 when we made our first funding of an apartment deal. And that's how we started, was as investors in those deals. And by 2015 had sold all of our properties, and all that equity that we had in single family properties was now in commercial deals, mostly multifamily. And then over the next couple of years, decided to go into actually syndicating and officially partnering on these deals.
Hey, that's a great thought, but let me get to this question that I just got from one of my followers right to my phone. By the way, did you know you can text me at 703-215-1684? This is a new thing I've rolled out. I'm letting my listeners and people that subscribe and follow me on social media connect with me directly to my phone on text message. It's me answering them and responding. You can ask me anything about real estate, investing, business, whatever. Just text 703-215-1684 and I will respond to you.
I love how you you started fairly small and grew from buying properties $3,000 down, $10,000 down, getting all this equity, and then now bigger commercial deals. What did you like better about the commercial side, multifamily, now storage as well? What do you like better about that? Is it just the deal size, of the returns better? Is it more scalable? Is it more time for you to do fun things, or all of these, or
yes, and yes. So if you're listening and you're a professional, right, and you own properties, it's like you know the headaches of dealing with managing properties, and some people they're cool with that. They like that. They enjoy that. For me, working 60, 80, 100 hours a week, I didn't need that as extra stress and time to deal with those. So I like the passive nature as an investor. Also as an investor, and this is actually what I was discussing with my son this morning. We were talking about condos versus apartments. And I said, oh, those are condos. And he's like, well, how's that different? So I was explaining the structure. I said, hey, Ethan, think about this. That's his name. Let's say there's 100 units, 100 condo units or 100 apartments, and you go buy one condo and rent it out. He's like, okay. I said, maybe it costs you $50,000 or $100,000 to buy that condo. If you rent that out and you have, say, $500 a month coming in, that's pretty good. And he's like, yeah, okay. I said, now let's say that person moves out and they stop paying rent. How much money do you have come in? He said, zero. I said, and do you still have to pay your expenses? He said, yeah. I said, now what if I got 99 more people together and we bought the entire building, but now it was an apartment building? He's like, okay. I said, there's a couple things that are better. One, you can hire people to manage it for you, so you don't have to self-manage it, because it's, you can spread that expense across 100 units. Two, if one person moves out, you don't have 100% vacancy, you have 1% vacancy, right? And three, and this is one thing I love as a finance, getting my MBA in finance, you learn about how to value businesses and stocks. An apartment building in income producing commercial property is actually valued like a business, Dan. You probably know this, but if you're listening, you don't. This is like when the light bulb went off in my head. And it's one of the things when you have the income of a property determining the value of the property, and you can actually change the income, you can force the appreciation upward. So I like the scalability. I like the ability to have a better quality of life if you're an investor in these properties. And I like the control that you have when it comes to the actual value of these properties. And by the way, there's also some better tax benefits that come along if you're a high income earner.
Well, actually, I was going to ask about that. Did you take advantage of that? Because I'm sure when you got out of those residential properties, you had a lot of gains on realized. So did you have a method or way to reduce your taxes when you made that transition?
Yeah. So one of the things I work with with my coaching clients, especially W-2 earners, there's a lot of tax strategies out there that aren't well known by your average layperson, because your average CPA, they just, you get your receipts at the end of the year, they do your taxes, they send them in. They're not a real tax strategist. So there's some tax strategies that you can work through. And if you're interested in those, you can reach out to me. I'll give all my contact information. But when it comes to so yes, I did a bunch of different things from a tax planning perspective. But when you invest in a syndication, especially an apartment building, there's a ton of depreciation. So when you buy a house, let's say it's a $300,000 house, and the actual property is valued, the land is valued at $25,000. So the structure itself is $275,000. The IRS, the tax code says you can depreciate that on a straight line basis over 27 and a half years. So $275,000 house depreciated over 27 and a half years, that's $10,000 a year. It's pretty nice, right? You can make up to $10,000 of income and offset that with the depreciation, not pay tax. That's nice. With apartments, because you have so much more depreciable property inside of it, like washing machines, dryers, dishwashers, appliances, even the landscaping, for instance, you can appreciate that at a faster rate. And you can do what's called a cost segregation analysis. And I dig deeper in my book. So if you want to get my book and dig into this, we'll tell you how to get it as well. I'll even give your audience a free copy, Dan.
Awesome.
If they're listening today. But a cost segregation analysis, really what it does, it allows you to take that depreciation and move it forward. It costs a little bit of money, which is why most people don't do it if they have a single property. But if, again, you spread that expense over 100, 200, 300 units, it makes a lot more sense. So getting all that depreciation and being able to use some of that in my situation, it was very advantageous. Yeah.
And was your first deal something you partnered with other people? And if so, did you kind of all go in as partners, like pass the hat, or did you have a structure where you were like the general partner and you had limited partner investors, or how did you structure that first deal?
Yeah. So, and this is a great point. So whatever you're looking to do in life, I think it always pays a dividend to go find a mentor, a coach, somebody that can help you along the way. So my first partner and I, we got together and we had been investing. I had introduced him to the multifamily space, and he had actually been able to leave his W-2 job. And he said, "Hey, Chris, I want you to partner with me. I'm going to go buy an apartment building." Okay. Like, hey, if these guys that we invested with had less experience than we do in real estate, then we can probably do this. So what we did was we actually partnered with that group we invested with. So we went, we found a group of investors, started making phone calls. It took us about a year from start to finish to raise the funds and ultimately close on that first deal. But the most important piece of that story, Dan, is that we went and we did partner with the original group we invested with that gave us mentorship. They gave us training, coaching, documents, connections. They even found the first deal. So it was invaluable to get that leadership, that partnership, and that education along the way. Even though we had to give up a piece of the profits to do that, it really helped us limit the downside risk and also give the investors that were coming in the confidence, because they said, okay, like, who's the team on this? You guys have never bought in an apartment building. Why should we trust you? And it's like, well, part of our team over here has done it 10, 15 times, and here's their track record of success. So again, that was really the key to getting that first deal done.
Yeah, that definitely helps to have people like that, like you said, for your learning and just to get confidence from investors. Fast forward to today, I think you've added self-storage, or at some point along the way you did. You mentioned that. How do you structure your deals today? From finding them to getting the investors.
Yeah, and you know what? I realized I didn't fully answer your question last time. So I'll talk through that. But we have a GP LP part structure. So what we do is, again, if you're listening, if you know what a syndication is, then I'm going to be a little repetitive here for you. But we go and we syndicate a deal, which is really not too much different, Dan, than right if you and I partnered together and we bought a duplex, and we pulled our money and we bought a duplex together and shared the risk between the two of us. It's really not that much different than if we go out and we take 100 investors and bring them together and go buy an entire apartment community and do that. The difference is the structure is a little bit more complex. You get a nice 150-page document that you get to read through as an investor to illustrate how complex it is. But the general partners that go find the deal, my partners and I, we find the deal, we oversee the deal, we operate the deal. And then the LP, the limited partners that come in, they invest their money, they invest their capital, but they don't have to make all the decisions. They don't have to run the deal. They're passive investors in it. So we structure it in that structure. It's a little different from deal to deal. But the way it works is we pay the investors first. And by the way, we typically invest 5 to 10% of our own money in the form of the total capital raised. So we're investing in every deal alongside our investors. And if the deal performs as planned, the investors get paid and the GPs are the last to get paid. So if you're a business owner, you get this concept, right? A business owner, you pay all your employees, you pay all your expenses, and then you pay yourself last. So it's very similar to that. It's a performance-based agreement. And yes, we still do a ton of multifamily. We have a deal right now in Charleston, South Carolina. We actually closed the deal this week in Charleston as well. So this is our second acquisition in that market. We also launched a self-storage fund this year. And if you're interested in learning more about these deals, I won't go into specifics and bore everybody today, but on my website, nextlevelincome.com, there's an invest link, and you can click on that and you can learn more about how to get access to those deals. But a lot of the fundamentals that I talked about why I got into multifamily, they're still there. We have such a housing shortage today, which is why the market's so crazy. All these millennials, even Gen Z coming into the market, baby boomers retiring. It's incredible.
Yeah, it was like 2 million houses last year or so short that we needed built that didn't to meet the demand. So big shortage.
Yeah. I mean, and same thing on the apartment side. And, I think the thing that also gets lost, even if you can build enough units quickly enough, when it comes to apartments, if you build an apartment and you spend $200,000 to build that one apartment, you're probably not going to rent that for $600, $800, even $1,000, you're probably going to rent it for like $1,500 a month, or in the DC market, $2,000 or $3,000 a month because of the costs associated with that. And my point is, not everyone can afford these luxury apartments at the top end. So it takes a while for that supply to filter down through the system and actually support the demand of most of the people in there. And the same trends, people moving, people working at home or moving to new areas with a better quality of life. Or think about this, people that move into a house that maybe it's not as big as they wanted, or moving to a new market and they don't have as much space as they wanted. Those people need a place to store their stuff. Or baby boomers that are downsizing, they need a place to store their stuff. People that are spending more time outside with COVID and they have more toys, they have boats and they have four-wheelers, and like my family, we have a bunch of bikes. I raced bikes for a lot of years. You need a place to store your stuff. And when I didn't have a garage, we had a storage unit. And those same demands end up supporting the self-storage space as well, which is also going through a shortage.
What do you like better or not better about storage versus multifamily?
Yeah. Let's also talk about which one of my sons I like better. So I'm just kidding. So they're different asset classes, and we invest in multifamily, we invest in self-storage, we invest in mobile homes, we do commercial office. I like all of them for different reasons, and depending on the market as well. So I think mobile homes are a great play when it comes to an affordable housing supply situation that also gives you really nice risk-adjusted returns when the market turns down, because they're just very stable, even in downturns with respect to mobile homes. So I'll tell you that most of our investments in the commercial space are in multifamily. That's where the big part is. But self-storage, it's nice for some reasons. So for instance, if I say, hey, I'm going to raise your rent $200 next year, Dan, you might say, well, I'll move across the street or I'll move down the street. That's worth it because that's $200 a month, $2,500 a year. But if I say, hey, I'm going to raise your rent, $10 a month at your self-storage facility, are you going to move it across the street or down the street? It's maybe you don't even notice it because it's auto charged on your credit card. You miss the email. It's like, it's going to cost you $100 to move it.
It's a pain compared to the benefit.
Exactly. So, you can get similar increases in a percentage basis in self-storage with people not noticing as much. So, at different times they support one another. Again, I think having both very strong asset classes that are cash flow positive, that have upside, are very nice. They have slightly different advantages and disadvantages, but they're, again, I go to the demographics and they're both supported by very similar demographic trends.
Awesome. Well, this show has been great. I've had fun time hearing your story, hearing how you jumped into residential so early, and then now I've made the switch to doing big syndications and commercial. So that's exciting to see, inspirational for others as well. I always like to end the show with a HyperFast round, if you're ready for some rapid fire questions and answers.
Bring it on. I'll answer as quickly as I can.
All right. What's your best or biggest piece of advice to a new investor?
Yeah, I think we touched on it. And that is, find someone that has emulated the success that you want, that's already achieved what you want to achieve. And then see if you can have a conversation with that person, see if you can use them as a mentor, hire them as a coach, because if they can help you shortcut the path to success, that is going to save you not only money, but it's also going to save you what you can't buy back, and that's time.
Good one. What's the biggest mistake you see experienced, successful investors make?
Yeah, I think people look at the deal first. And I always tell investors, like, first off, look at the strategy, look at the fundamentals of that strategy, look at the geography, look at the operators. So if you're investing in a syndication, you want to look at the operator and vet the operator. You want to be with a well-established team, versus like, a one-man operation. There's a lot of risk, if you don't know an individual versus, if you know a group and see a track record of success. and then you look at the deal, and then you look at the numbers. It's super easy to make numbers look good and move them around. And if you're an inexperienced investor, you could look at something and be like, wow, these returns look fantastic. Well, we can make the returns look as good as we want. If you don't trust the operator and you don't understand, what really makes that different, that can get you in trouble. So start with the fundamentals, then work your way down to the deal. Don't look at the deal first.
What was the biggest challenge you've ever had in business, and how did you overcome it, or what did you learn from it?
Yeah. So interestingly enough, I was exiting in the past year here, the medical device space. And, I'm sitting there with my accountant over a year ago, and he's like, Chris, you're good. Like, your cash flow from your passive and real estate investments is good. You have plenty of money in the bank, like everything looks good. And I just couldn't bring myself to leave. And I struggled with it probably for about 6 months, Dan. And what I realized was, I'd worked so hard for 20 years to get to this point in my life. And I really didn't think about that next step. So maybe the dog that catches the car, I'm sitting there and I'm thinking I can leave. But after months of kind of thinking and working with my coach and, even meditating on it, what I realized was I craved significance. I wanted to be relevant. I wanted to get up and I wanted to have a purpose every day. And deep down, I think it really made me scared to think that I might wake up the next day and not have anybody call me and not have anything to do even. And that's why I started my coaching business. So, whatever it is you're doing, I think that the thing that I learned is you need to always have a bigger, more exciting future that's really bigger than you, that has a bigger meaning than you. And I was fortunate enough that I got to a point where I had to kind of deliberate on that and figure that out. But in the past year, that was something that was a real mental challenge for me, even though, you maybe listen and think, man, I'd love to have that problem. It was something that was really interesting to work through.
If you could start over, or if you had to start over, I should say, and you couldn't bring your money, you couldn't bring your connections, all you could bring is your knowledge and experience, what's the first thing you would do?
Wow. I would probably start a podcast like you and just start, because then you can make those connections back. You can, start to grow that. And that's what I've learned over the past few years of having our podcast, the Next Level Income Show. It's a tremendous networking opportunity. You can literally build a business around it if you wanted to. That wasn't our goal. But the thing is, when you go out and like you, Dan, you have this mission to go and you give and you help people, what happens is people are more willing to give back to you, and you make those connections and do that. And the second guest on our show, Richard Wilson, said, give away 80%, give away 80%, the 80-20 rule. And then you can charge for the other 20%. And I would, if I had to go back and start, I would have just started, giving more sooner.
All right. Last question. Where do you see yourself 10 years from now?
Yeah, well, I think my boys should be out of the house, theoretically. They'll both be over 18. My youngest is 9. So we'll be at another turning point in our lives, my wife and I. We'll hopefully be celebrating our 25th anniversary with a lovely lunch like we did today again. But really, I hope that I'm able to 10x the amount of people that I'm able to touch over the next 10 years. And continue to speak with great people like yourself and continue to provide education out there. But it's been a real pleasure to be able to help people and, just trying to expand that vision even bigger than I have right now.
All right. Well, this has been amazing. Before we wrap up, if people want to learn more about your coaching, investing with you, your book, or just connecting with you, what are the best ways for them to do that?
Yeah, thank you. Yeah, I almost forgot to give the link. So nextlevelincome.com. If you click on the book link, you can put in your email, get a free download. You can even put your address in, and I'll send you a free copy of the book. And we have the invest link up there as well. We're going to be launching a coaching course in 2022. If you're interested in getting a sneak peek at what we have coming, you can email me, coach@nextlevelincome.com.
All right, well, check out Next Level Income. Did I get that right? Nextlevelincome.com.
Perfect.
And check out the book or Investing with Chris. Thank you again, Chris. This was an amazing show. To all of our listeners and viewers out there, thank you so much. And if you got value out of this, which you should have, please share it with someone else you think that would have. And we will see you next time.
Thank you, Dan. Appreciate it.
Thank you for tuning in to this episode of the HyperFast Show. Subscribe to us if you want to make sure you get the latest and greatest HyperFast shows. And remember, we love reviews. Reviews help us bring better and better guests and improve our shows. So give us the good, the bad, and the ugly. We hope you enjoyed the show, and we will see you next time.
Hey guys, thanks for sticking around to the end. I hope you enjoyed that video, and if you want to see more, click right here. And if you want 100 real estate tips from my best-selling book, click right here to download them instantly. And if you're new to this channel, click below to subscribe and turn on post notifications so you don't miss out. And leave some comments about what you think on the videos.